morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Joining me today, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is the tax expert for individuals and small business owners. We were talking before the break about the different types of income and everything, and I was sharing with you that little trick about capital gains, right? And I used an example of someone needed $100,000 in income and they had $50,000 from Social Security, that we could take $60,000, cap out of capital gains, cap out that 12% bracket, and pay zero tax on that capital gain. So here's a person now, think about this, $50,000 in income, the first on their Social Security income, and technically if it's actually going to be only 85% of that, or about,
yeah, exactly,
right,
but
42,500 that's going to be taxable. Of that 42.5 that's taxable, right, I've got my standard deduction, that's around 28. So now what have I got, 14,000 that left in tax? That's going to fall into the 10% bracket. I'm going to pay $1,400 in tax on $100,000 in income through that type of strategy. So think about that.
That's pretty good. I like it. I think we can go with that.
So $1,400. So I've just reduced my tax rate on $100,000 and a 12, well, not even going into the 12% bracket. But I've reduced it down to like a 1.5% tax rate.
Yes.
Now, what if the person needs $150,000 in income?
Now we need some magic.
Now we're crossing over into that 22% bracket, which we want to avoid. Okay, so how do we get that money? And this goes to the capital gains part and how we can balance some things out on the taxes to accomplish that goal. This is where Roth can sometimes be beneficial as well. So that if I can pull from areas I'm not going to have to pay as much, pay any tax on, or at the very least minimize my tax. So if I cross into the 22% bracket, I use capital gains at that point, which will bring my tax rate down to 15 instead of 22.
Right.
All right, now, Friday, there's another tip I'd like you to share when we were talking a little bit about this excise tax you brought up, the 3.8, the Medicare tax, as you put it. And understand, because we're going from a progressive system where each bracket you go up, you only pay that higher tax rate on the amount that you're in that bracket. But capital gains, as we said, once you cross that threshold, everything even 15, below the threshold gets taxed at 15. How does it work when you hit that? Now, first off, what is the threshold for the Medicare tax?
The Medicare tax for a single person is $200,000, and this is one of those, like we were talking a little bit about Social Security. So they've set these numbers, these amounts, and they haven't changed them, right? So every year your income goes up a little bit because of inflation or whatever else, but these dollar amounts haven't changed. So more and more people are going to hit them easier as time goes. So you get $200,000 for a single, and a married couple is $250,000. Not fair? Sorry, guys. Don't make the rules. So those are important numbers that if you're doing this tax planning, so we talk about the progressive and keeping you in the 12% tax bracket, which is basically less than 100,000 or 111, I think is what he said. And then you've got the capital gains, which means theoretically the 15% for a single person goes all the way up to 258,000. But if you go to the maximum, if you go over that 250, that last percentage, so everything above 200,000, excuse me, for a single person, anything above that 200, so even though you got $58,000 according to the 15% tax bracket that you have, is supposed to be at 15, is not. It's at 18.8. They are going to hit you with an extra tax. So you look at your capital gains schedule, it's just going to show that. But then there's another schedule that kicks on, called Medicare, and they're going to hit you with 3.8 on that. So understanding the progressive, how far you can stay to the 12%, staying within the 15, and when those sections are going to actually truly hit you with another tax within the tax code. Very sneaky.
And this is on the 3.8, as Dr. Friday was just saying. That means when if you go over that threshold by how much ever, it's the 3.8 is only going to apply to the amount for single over 200,000, for married over 250. And now that includes gains. All right, so when you're talking about, and I can't remember exactly, but I think it has to do with the gain or the lesser, like the lesser of the gain or the income, total income. But basically, once I cross that threshold, let's say you go over 8,000 in Dr. Friday's example there, that 8,000 is taxed, is the only amount taxed at 3.8. Now, I've got a client that just came in. This is one of the things we're balancing out for him on his income plan, is how we're going to go up to, right, stay under the 250. But it was one of the things that I pointed out to him. I said, look, if we miss it by 1,000 or two, it's not like the capital gains where if you miss it, everything's taxed. This one, if it's over 1,000 or 2,000 and it's only, you know, that amount at 3.8, you know, you're talking 40 bucks. It's not the end of the world. But this is, you know, we still are looking to stay within not triggering that tax, but certainly, at least at the very least, minimizing any amount that it would apply to. The overall goal being, too, when I do the projections for someone and I'm looking at the required minimum distributions at age 72, one reason we do the projections so we can see how much their retirement accounts are going to grow, less any income they may take from them, what the required minimum distribution will then be based on that growth when they reach age 72. And then look at that income and add it to their other income, and what is that going to do in terms of the tax bracket they're in? Is it going to cause a lot of that money to be taxed at a higher rate? And if so, what kind of things can we do now? Maybe we start cashing out the IRA for income. Maybe we do some Roth conversions. It's all about balancing all this out so that we're not just looking at taxes this year, but over your lifetime. And one of the things that, you know, again, this starts with, we're going to look at the next slide, tax-deferred sources of retirement income. And Friday, let's talk about, again, the type of income in the example here, and then the type of taxes that would apply to that type of income.
Right. So most people put money into a pension, and so they get to defer ordinary income. Same thing with 401ks, 403bs, 457s, and your traditional IRA. Right, so when you either take it out of your paycheck and it reduces box 1, or you put it on your tax return and it will reduce it and give it, either way you'll get ordinary income credit for depositing that money in. And then you have annuities. Many times people are deferring ordinary income in those situations. And I will say, if you're at a lower income bracket, there's still a saver's credit. So there's an advantage to putting money in these type of accounts, or a Roth IRA, where the IRS actually gives you credit on your tax return. So, so it's a good thing to defer your money if you can.
And when they're talking about tax-deferred sources of income, notice also these are all the examples given in this first slide are going to be taxed at ordinary income tax rates. And anytime you hear that term, ordinary income tax rates, I want you to think to remind yourself and remember that is the highest income tax rate you can pay. It doesn't get any tax benefits, no tax-free, no capital gains or qualified dividend rates. You're paying the highest tax rates there are. So we want to try to minimize those, of course. And now let's look at the tax-free sources of retirement income in this slide.
Yes. And this one, of course, is my favorite, right? Tax-free. If I can maximize this would be good.
That's it. Tax-deferred is good. Tax-free even better.
Right. So you have certain municipal bonds, like capital gains, if any, because sometimes so they don't charge it on some of them. The next one, of course, most of you guys know, retirement savings, which is the Roth 401k, the Roth 457, the Roth IRA, because we put it in, we've already paid tax on it, but it grows tax-free. So there's no tax when we take money out. The health savings, or the health reimbursement arrangement, sorry. The HRA is non-taxable. The health savings account, which I am a big advocate for, because no matter what, we're going to have medical expenses. And as long as you use it for medical, completely tax-free. And that's a wonderful non-taxable portion of Social Security, which is what we keep talking about. Up to 85% can be taxable. So that other 15% is tax-free. And of course, life insurance is a non-taxable situation.
And it's important to also understand when they're using these examples that there are qualifiers. So that we're talking about tax-free, but in reality, they're technically growing tax-deferred. And then when if you take it out according to the rules, then that withdrawal could be tax-free. But you have an example would be putting money into to an HSA, if you take that money out for medical purposes, then it's tax-free. If you take it out for others, it's going to be taxable.
With a 20% penalty.
Exactly, potentially subject to a tax penalty. One of the things when it comes to the tax-free as well, like municipal bonds might, little qualifiers might have state taxes depending on the type of muni it is. Also, when it comes to tax-free and how these things work and how, understanding how the rules work, just like with a Roth IRA, in the example we use, one of the things with Roth is that a Roth IRA, when you take the money out, is going to be tax-free, and it's not subject to required minimum distributions.
Yes,
In other words, I can leave it in my entire life. However, watch out that if you have a Roth 401k or 457, those are subject to RMDs. So if you do find you've got money in those, one of the easy fixes is to do a rollover, basically take that 401k, that Roth 401k, convert it over to a Roth IRA, and thus you can avoid the RMD. All right, more tips to follow, but first a break. Join us here. We'll be right back on the Retirement Report.